I think the Fed does cut rates another, 50, 75 basis points. So we already cut close to 200 basis points in the last 2 years. So this is a pretty good cocktail for owning stocks.
All right, joining me will be John Davi, founder and chief investment officer at Astoria Portfolio Advisors, who every year Astoria publishes a list of 10 ETFs they're tracking heading into the new year. And I love this list because they're essentially trying to identify what they think will be key themes in the financial markets every year. And then they're providing real actionable ways to play these themes. And so John and I are going to walk through a number of the ETFs on this list for 2026, and he'll give us his rationale for each of these. And if you haven't heard John before, I'll tell you, he's always such a breath of fresh air because he's not afraid to put himself out there and actually operate with some conviction. I feel like he always calls it like he sees it, which I certainly appreciate. So in any event, he'll join me momentarily to walk through those ETFs for 2026. And then later, I will be joined by both Ryan Barksdale, who is head of active equity product at Vanguard, and Kim Galen, who is head of equity boutiques at Wellington Management. So back in November, Vanguard actually launched its first active equity ETFs. There are 3 of these ETFs in all. These are all in collaboration with Wellington Management. And I think this will be an interesting conversation because we're going to discuss this long-standing relationship between Vanguard and Wellington. We'll then get into how Vanguard is approaching actively managed ETFs overall and how they're attempting to meet investor needs and expectations in this category. And then we'll discuss their future product roadmap, essentially how Vanguard is thinking about active ETFs moving forward. And I always say, I know the first thing everyone thinks about when they hear Vanguard is index-based investing, but Vanguard is actually one of the largest active managers in the world. I think people forget about that. So again, that should be another great conversation. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let's start this week with John Davi, founder and chief investment officer at Astoria Portfolio Advisors, who is joining me from New York. John, welcome back to the podcast. Always great to connect.
Yeah, thank you, Nate. Really appreciate the opportunity.
Okay, so every year you put together this list of 10 ETFs that are on your radar heading into the new year. And as I mentioned, I love these because you're essentially trying to identify what you think will be key themes in the markets. And then you are providing real ways to play these themes via these ETFs. And you've been doing this for what, over a decade now?
Yeah, this will be the 15th year that we've been producing this report. So excited.
Yeah, and I should mention anyone can go download the full report on these ETFs by going to AstoriaAdvisors.com. And so, John, before we get into some of the specific ETFs, can you talk more about the selection process here? Like, how do you actually go about putting this list together?
Well, it's funny because before Astoria began, I was an ETF analyst at Merrill Lynch and let's say Morgan Stanley. So I put together this list because I sort of wanted to get like a track record and, paper portfolio just to kind of show that I had good investment ideas and that I could sort of, put together a portfolio. Now Astoria principally runs, ETF managed portfolios, and we've got a couple other verticals, but the genesis was like, I was the guy covering ETFs, talking about flows, trends, key developments, meeting with all the issuers. And then I just decided to, kind of put like the top 10 ETF list for the upcoming year. So this is the 15th year. Historically, it's not meant to be like a model portfolio. These are more dynamic satellite ideas. And really what you said before, I think, is what I'm trying to accomplish, which is like deliver the idea and then have an ETF as a way to express it. But more importantly, kind of like deliver a concept. So when we say this year, we think you should structure your outcomes, and we have a couple of outcome-oriented ETFs. Like I just think there's a lot of risk in the marketplace, and you want to, get very specific with what you're trying to accomplish in your portfolio.
When you talk about dynamic satellite ideas, I just want to make sure people have some proper context here as we go through these. How tactical is Astoria? Or I guess as people look at this list of ETFs, are these shorter term tactical plays, longer term buy and hold positions, something in between? How should people view these ETFs we're going to talk about?
Okay, I would say that it is meant to sort of have like a 6 to 12 month holding period. It's certainly not meant for the next 1 month or 1 quarter. We are longer term in nature. When we put together like our portfolios, there's always a core and satellite, and the core, we're expected to own it for several years, and then the satellite would be something that I would say, could be closer to like 1 year or like 9 months. So, we're not very tactical. I would say we are more risk managed. Tactical to me, there's a couple different ways to sort of describe it, but tactical could be just like you go in and out of the market, where, that could be like weekly, monthly, or it could be like you just have like a very big cash buffer. It could be, 50% of your portfolio, 25%. We never go to cash at Astoria. So the intent on the 10 ETFs is not to be tactical nature. It's to be longer term. It is satellite, but even our satellite, the way we define it, as I mentioned, is more like, 9 months, kind of a 1 year.
And to set the market backdrop for us as we go through these ETFs, can you give us your overall sentiment right now as 2026 gets underway? I know you mentioned in the report that stocks are showing some of the strongest bubble dynamics that you've seen in decades. Though, to be fair, you do say that, something has to happen to actually puncture a bubble, right? Just because there are bubble dynamics, that doesn't mean stocks are going to immediately fall off of a cliff. But just set the overall backdrop here on how you're viewing the markets right now.
Yeah. So I would say, we are constructive. There's really sort of three reasons. One is tax cuts, tariff cuts is the second, and then rate cuts. So as long as I've been managing money or doing research, anytime the Fed cuts interest rates, that's usually a very stimulative impact and effect in marketplace. So there's a lot of fiscal stimulus out there. You've got the one big beautiful bill that's going to be 1% of GDP this year. GDP Atlantic now Fed is like 5%. Obviously you have Trump that's doing what he can to kind of support the consumers, whether you think about like the credit card, limits that he's looking to do, or his involvement in the Fannie Freddie, like supporting the mortgage backed market. I think the Fed does cut rates another, 50, 75 basis points. So we already cut close to 200 basis points in the last 2 years. So this is a pretty good cocktail for owning stocks. I would just argue you don't just need to own like, SPYs and Qs, which are like 40 to 55% in 7 stocks. You should rotate. There's a whole world of opportunity out there. We think international makes a lot of sense. We think mid cap makes a lot of sense. There's very idiosyncratic, good stories in financials, industrials, utilities. So we want to capture as many of those opportunities as we can for our clients at Astoria.
Okay, so perfect segue here. Let's get into some of the ETF picks on your list. And we're not going to get to all 10 just given the time constraint. So I've selected, I think, 5 or 6 of these. But again, people can go download the full report if they'd like at AstoriaAdvisors.com. And so to start, I want to ask you about an ETF that's actually on my radar as well. And you just alluded to this. That's the iShares MSCI ACWI XUS ETF. So ticker ACWX. And I'm not sure if you saw this, John. So I do these 5 ETF predictions every year. And one of mine, okay, so then one of mine for 2026 is that international equity ETFs are going to smash their annual inflow record. I'm very bullish on investor demand here, and we're seeing some early signs of that. And I'm happy to talk about why I see that. But I want to hear your case for international equities, because before last year, as you know, it was extremely tough sledding for investors who had any sort of meaningful allocation to international stocks. And so I'm curious, did the outperformance last year give you the confidence to put something like ACWX on your list, or are there some other key drivers here?
Well, let me give you a sort of a long-winded answer, although I'll try and make it quick. But basically, like when we had the great financial crisis, interest rates got pinned down to zero. We did massive amounts of QE from 2010 to 2020. Living in a negative interest rate environment, I mean, it sort of doesn't make a ton of sense to me. So I think we were living in a deflationary environment. Technology stocks are long duration assets. They sort of can grow in a lot of different environments. But the idea is that, like, from 2010 to 2020, when interest rates were artificially suppressed, it really did favor U.S. and longer duration technology stocks. And then COVID really was a regime change, in a sense that, all of a sudden now we were doing, fiscal stimulus. We, helicopter money, giving money, directly to consumers in their pockets. It led to massive inflation, higher interest rates. And what you saw was, like, international didn't really work in the first couple of years, but international stocks by nature tend to be more cyclicals, like industrials, more financials. They are more rate sensitive. They also have, like, a very different factor overlap. And, I think the real catalyst for international was Trump being elected. You start seeing a lot of protectionism policies that, our country instituted, as well as like Germany. So anytime in my career, and if you just look at the research, when the dollar weakens, typically the best performing assets and sectors are gold, emerging market, developed market. And, that is exactly what happened last year. Gold was up, 60%. EM and DM were up, 25, 32. So I do think you should own international. I think it's time to, like, rotate away from US, which is, we just want diversification. I mean, S&P is no longer a diversified index. So that was my case. I'd love to hear your rationale.
You hit on a lot of the major ones. I mean, certainly a weaker dollar is a big catalyst in my mind, because if you look historically, international does tend to outperform when you have a weaker dollar. And Trump is on record as stating, that's really one of the primary goals that they have, is to lower the dollar. Falling interest rates, I think, would be one. I think you hit on the other catalyst, which is that I think a lot of investors are looking at U.S. stocks, and they do see historically elevated valuations. They see the top heaviness and market cap weighted indices in the U.S. And so they're saying, okay, how do I gain some diversification? And obviously a place to look is international. I guess on that note, with valuations, John, people have been talking about how international stocks look more attractive on a relative basis. People have been talking about that for a long time, but that hasn't necessarily produced outperformance until 2025. How do you think about valuations when you're looking internationally? Like how much of a factor should that be?
I think so. In our case, we tend to run like this 4-factor model where we look at, like, valuations, but couple that with, like, earnings revision, earnings momentum, and growth estimates. And really, what you want is, like, a low, let's say P. You can use P. We tend to use other valuation metrics, but a low PE ratio combined with, like, high growth estimates, good earnings momentum, and strong estimate revisions. So when we sort that across, like, international, US, across 15 different ETFs, we tend to see international at the top of the list, which is great. And you can't really obsess over valuations. You have to have a catalyst, and I think the catalyst for us was, the weaker dollar, with Germany doing the massive fiscal stimulus, Trump being reelected, and then all of a sudden the dollar, which was very, very strong, we started in 2025 at like 105. It traded down to like 120 pretty quickly, and that's I tend to focus on euro dollar because we go to my family's from Europe. And, most of my adult career, since the euro was created in 1999, 2000, the euro has been around 125 to like 135. So being at 105 was very cheap. So it kind of like was the catalyst, the weaker dollar. And, I think it'll continue.
Yeah, the other factor that I would add in here, I think, is just performance chasing or some momentum because of the outperformance that we saw in 2025. I think you have investors, and I would say especially professional investors, if they lagged, say, a global market cap weighted portfolio last year because they were underweight international, they may look to rectify that clearly by allocating more to international. And so I wonder if you get a little bit of performance chasing there, especially if the outperformance continues. And it's kind of funny because, as you know, if you had a meaningful international allocation over the past 14, 15 years heading into 2025, you've had some very difficult conversations with clients because of that, but that can flip quickly, right? And if international continues to outperform, you're starting to lag performance wise. And so I do think that that could be a factor as well. Okay, let's move over to the fixed income side, where one of your ETF selections is the PIMCO Multi-Sector Bond Active ETF, ticker PYLD, which I'm not sure some people realize that thing now has over $10 billion in it. It's quietly one of the larger active fixed income ETFs out there. But you talk specifically about the need to be active or be tactical in fixed income. And so do you want to explain the rationale for that?
Yeah, I think, generally speaking, like the equity side of the picture is pretty clean, right? Like we're telling people, okay, tilt away from Mag 7 just for diversification. Um, we like equal weight, we like mid caps, we like real assets, we like international, right? So that I think is pretty clean and you can kind of set it and forget that type of portfolio construction. But in the fixed income side, I just find like the risk to be, very nonlinear and much more of a need to sort of be active. There's a trade-in range in rates. Also corporate credit is fairly, expensive. There's more idiosyncratic areas, whether it's like emerging market, asset-backed securities, mortgage-backed securities. So, we just think that PIMCO's got a deep, credit expertise, deep bench. They can sort of manage that risk, very, very well. So I think you just have to be very active in fixed income, and you could be more passive in equities. So PYLD, we really like Sonali, the PM. It's currently it's been live since like July 2023. You shouldn't buy anything on just pure performance, but I mean it's outperformed the ag by 12%. Since it went live in July 2023. It's about a 5 standard deviation. She does have the ability to sort of go into these idiosyncratic areas, emerging market debt, asset-backed securities. So she's very strong. PIMCO's very strong, and it definitely solves a need on our side. I would say, rates coming down, you should sort of get, there's this T-bill and chill trade that, dominated for many, many years. And, it's time to get out of T-bills because the point that I've been making is, the ag last year was up 8%. Great. But you lost, half of that to just the CPI, government inflation. And if you look at real world inflation, if people are buying bonds or T-bills just to kind of keep up with, grocery bills and car, I mean, real world inflation is north of 8%. So you sort of lost on a purchasing power basis quite a bit. So going into more credit and idiosyncratic areas within fixed income, I think will give you a much better shot at keeping up with the rate of inflation, which, we're living in a structurally higher world. This is now year 6 of sticky elevated inflation. So, we like to say at Astoria, once the inflation comes out of the bottle, it's really sort of hard to put it back in.
Do you have any concerns on the credit side that we do have historically tight credit spreads? I know that's giving some investors some pause from allocating, particularly to high yield. Do you have any strong views there?
Well, it's funny, like last year, we wrote an outlook and we were not as constructive, and we sort of had this tagline like, everything's expensive, so we're headed, we're overdue for a big fat correction. And that was something that like got picked up by like Barron's, and that was like the cover article, the cover subject line of my interview with them, like we're headed for a big fat correction. Yeah, I mean, like I do think that like there's a lot of areas of of equities, in the US at least, that's like sorely fairly expensive outside of like international, which we've talked about, in small caps. Within fixed income, yeah, I mean, I would say I don't personally like owning a lot of T-bills. High yield credit is, fairly rich. But, things can stay rich for a while. And, again, everyone is like very, very constructive, and we are as well, which usually means that, a different outcome will populate at some point in 2026.
All right, another ETF on your list, which I think this one makes a lot of sense given what you've said thus far here today, is the Spider Bridgewater all weather ETF, ticker ALLW, which this just launched last year. It's already up to 700 million in assets. It's had a really nice debut. Do you want to explain what you like about this one? I think you've already hit on some of the key points, but I'll let you elaborate.
And yeah, we have a strong partnership with State Street. And, I got to know the portfolio manager of All W. He spoke at my macro summit conference last year. The concept is really sort of allocating risk across asset classes dependent on like prevailing growth and inflation environments. Um, and I think of it as sort of like, somewhere between like stocks and bonds. What I tell advisors is, S&P historically is about a 17 standard deviation. Bonds are like about a 5 standard deviation. This is more like 10 to 12. So it's going to, I mean, we tend to fund it on our side from our bond allocations. But, I would say, given that I have this view that like you've got to be much more active in fixed income, more tactical, it was like a natural substitute for us because, it does sort of act as a quasi, stock and bond. But, what they do is, with their, deep, expertise and asset allocation and and tactical management. They look at like okay, are we in an up inflation environment, high growth environment, or high inflation, low growth environment? So they have like these 4 quadrants, and they just look to see like okay, historically what worked best when you're in like a high growth, high inflation, low growth, low inflation, and what asset classes have performed historically best in those prevailing periods. So the fund has actually, kept up with the S&P since it's launched, which, as I said, it's got, sort of, let's say, 40% lower risk. So we're very pleased with that. And, it just solves a need on our side because, we can't be very tactical in an SMA format, but we want like the ETFs we use to kind of do a lot of the risk management for us.
And you mentioned funding this position out of the bond side of the portfolio. That was actually something I was going to ask you about. How you view this in the context as it's coming out of the equity sleeve or the fixed income sleeve. Can you just elaborate on that a little bit more? Because I do think that's something that advisors struggle with when looking at an ETF like this. Is where do I put this in the portfolio?
Yeah, and I think like it's sort of been challenging, right? But the 60/40, I would say, we sort of moved to more like a 60/20/20, and we want sort of like 20% of the fixed income to be things like, All W or PYLD. PYLD is more traditional fixed income, but whether it's like real assets, gold, precious metals, things like OW, we want that to be like in the 20% bucket. I think that, the idea is like, okay, fixed income, we thought would be challenged about, 4 or 5 years ago. We launched in December 2021 just because we thought inflation, could have been a problem. And, here we are, 5 years later, and we still have like very elevated inflation. So we just want, we want to fund our alts from like our fixed income, generally speaking.
All right, let's look at a couple more ETFs on your list that caught my attention here. First, the Calamos Auto Callable Income ETF, ticker CAIE, which again, this is another ETF that launched last year. It's also been a really nice success, now over 500 million in assets. And then in addition to that ETF, John, I saw that you also had some commentary around structured income or more traditional defined outcome ETFs in general, just how you think that maybe 2026 could be a good environment for these types of products. So talk more about that.
Yeah, I'll talk more high level about, sort of the space. So I think the risks right now are, everyone's sort of like euphoric. It feels like, valuations are pretty stretched, in the US. And, at the end of the day, like, I think there's, as much as we want to push people to like international and some of these like idiosyncratic areas, like whether it's like banks or real assets, there's generally more skepticism, I would say, because, the US has worked so well. I would say advisors are more open to, kind of these buffered like hedge growth ETFs, whether it's like, the Calamus products or, just the regular SIBO buffered ETF or things like JEPI. But all of them sort of like will sell volatility in some shape or form. Think of that like volatility as insurance, right? So, when you buy a car or you buy a house, automatically you have to go out and buy insurance. And the people that sell you those insurance, generally, I believe, sort of, are profitable. If you think about, insurance companies, there's huge moats. Buffett sells insurance for a living. So the Calamos products just sells like extremely low downside puts. And as long as like, there's no major catastrophe in the marketplace, like you'll sort of benefit from selling that premium. So it's a big yield play. But the concept really that I wanted to emphasize is not so much, because we don't own either the structured, ETFs that I have in my report, but just I do think that concept needs to be very defined, especially for advisors that are older and have older clients, because I think the risks could be very non-linear this year. There's just these cross currents that sort of like when we think about it, it sort of gets, we're running like very elevated inflation now, and we're sort of throwing like gasoline on the fire by, all these stimulus packages. So that's the idea, is like structure your outcomes, whether it's the upside in case of option overriding or downside in case of the calamus. And as long as you don't have like big views that market's going to like really blow off the top, I think you'll benefit from selling, from buying like option overriding strategies. Or if you don't think there's some big left tail risk, I think you probably benefit from owning like a calamus ETF.
The thing that amazes me about the structured outcome ETF category overall is that if you think about the performance we've had out of, say, the S&P 500 over the past 3 years has been tremendous, and this structured outcome ETF category has grown uh, remarkably. Imagine if we actually get into an environment where we have real volatility and a substantial drawdown. I know we had a quick drawdown last year, but imagine if we get into a much more turbulent market environment. I think those products are really going to attract an audience. So I have my eyes on that category as well.
And Nate, I worked at big investment banks for 20 years before Story began, and we did all these auto-callable structure notes. I mean, there was always massive interest in them. So the first 10 years of my career, the S&P was down 20%. It was kind of the lost decade for equity. So I know that seems unimaginable now that you can have 10 years of no upside in the S&P. But as someone that was sort of trained, in a pretty ugly bear market, so we launched what we call our hedge growth SMA, where we dynamically manage, a lot of the sort of, option override and sort of buffered ETFs. And, what we try and do is target, let's say, a 9 to 10% total return. 7 comes from yield, and then the rest comes from capital appreciation. And the idea in the hedge growth space is basically, or we call hedge growth, is like, okay, if the S&P is going to be up 20, we'd be happy making 10%. But if the S&P is down 20, we want to sort of be down 7. So we put out this hedge growth SMA, and I mean, it was just the interest we had last year was just unbelievable. So I think there's demographic reasons why there's still interest in it. But you're right. If we ever got a sustained bear market, there would be, a lot more inflows into these products.
All right, one more ETF that I have to ask you about, which you won't be surprised I'm asking you about this one, but I was a little bit surprised that it was on your list because for some reason I didn't think you were a big crypto advocate, but I think I just missed that. So you have the Bitwise 10 Crypto Index ETF, ticker BitW, on the list. What do you like about crypto this year?
Let me give you again like the sort of rationale. So when we started a story, we said, look, there's going to be sort of these pillars we believe in, right? So after tax, after inflation, risk adjusted returns, right? After tax, after inflation, risk adjusted returns. And, everyone thinks about nominal returns, but you really got to think. So we've always principally guarded our portfolio to have purchasing power. So we've always owned gold, some version of like either gold, bullion, gold miners, commodities. We sort of had to wait for the crypto ETFs to launch, and then it sort of got carried away. But it's a fixed supply asset. Last year, this year, the deficit risk that we've taken on in this country, and it's a global thing now too, right? Everyone's sort of inflating their money supply. So, I think crypto, deserves a place in a portfolio with W. I would say, buy and hold it. Don't try and tactically, trade it. I think, there's something about, there's only 21 million coins available. 19 and a half have already been mined. So it's the ultimate, sort of scarce asset. And, I think long-term Bitcoin price goes up considerably. I don't have like a forecast in play, but within our ETF, we have about 3% in the Bitwise ETF. And, I think that's sort of the right amount. We tend to like gold a lot more. So like we have like a 10% gold allocation. And the idea is that, you have to kind of protect your purchasing power. And I think Bitwise is a tool to kind of help that. But, you should also own other diversified real assets, including, gold miners, physical commodities. And, I'd even go and say, Nate, even things like collectibles, physical real assets, real estate should be part of your plan. So I have deep concerns about the US dollar has lost 50% of its purchasing power over the last, 30 years. So stocks will help you, but then there's other ways to kind of help your inflation protection.
Yeah, and to your point on commodities, I'll note that you also had the simplified commodity strategy, no K1 ETF, ticker HARD, HARD on the list as well. So, hey, John, before I let you go, I know that you were on the advisor council for the Exchange Conference, which is coming up in March in Las Vegas. I'll be there. I was actually discussing this last week with VettaFi's Todd Rosenbluth, so he gave us a nice preview. I'm just curious, is there anything that you're particularly excited about, given that you actually had direct input into planning this event?
Well, I mean, it's in Vegas, so, it's hard not to be excited in Vegas. It's, the best ETF conference out there. You got, I enjoy being around the issuer community, and, ETF strategists and then advisors. So as somebody that's been going to that conference for over 10 years, there were a lot of new faces last year. So you're able to kind of give like the West Coast, easier opportunity to kind of take part in the conference, as opposed to like having them travel from West Coast all the way down to, South Florida. So, it's early in the year, so content is going to be fresh. And, we have a lot of cross currents in the marketplace and a lot of nonlinear risks. So, I just think it's the first big notable conference you get to hear from all the big thought leaders out there. So I'm certainly excited to attend and participate and be part of the advisor council.
All right, beer's on me. We'll go hit the blackjack table for a little while, see how that goes for us. But certainly look forward to seeing you there in March. And again, I always enjoy this list of ETFs you put together every year. So thank you for coming on here and discussing that.
Thank you so much, Nate.
That was John Davi, founder and chief investment officer at Astoria Portfolio Advisors.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
I'm now joined by Ryan Barksdale, head of active equity product at Vanguard, and Kim Galen, head of equity boutiques at Wellington Management. So, of course, Vanguard is currently the second largest ETF issuer in the country, nearly $4 trillion in U.S. ETF assets. And back in November, they expanded this lineup by launching their first actively managed equity ETF. So there are 3 of these ETFs in all. These are all in collaboration with Wellington Management. And I'll just go through these real quick. So there's the Vanguard Wellington US Value Active ETF, ticker VUSV, the Vanguard Wellington US Growth Active ETF, ticker VUSG, and then the Vanguard Wellington Dividend Growth Active ETF, ticker VDIG. But Ryan, I want to welcome you back to the podcast. And Kim, it is a pleasure to connect. Great having you on here as well.
Thanks, Nate. Good to be here.
Nate. Great to be here. Thank you.
Okay, so Ryan, I know that last time you were on here, we had a really nice conversation around Vanguard's long history and expertise in active management because, I think many investors, when they hear Vanguard, the first thing they think of is passive investing, right? Index-based investing. But there is a long history here on the active side, including this relationship with Wellington. And so I thought to start, it might be good to pick back up on this topic to help set the backdrop here. Do you want to talk about Vanguard's history in active management and this relationship with Wellington and why it has been so beneficial?
Absolutely. Thanks again, Nate. Yeah. So to your point, we have 50 years of experience at Vanguard. We celebrated that anniversary early last year in 2025, and for the entire time, we've offered active management capabilities, and for that entire time, we've partnered with Wellington. So, for us, it's been a fruitful relationship and partnership over those decades in terms of being able to deliver the right investment outcomes for our clients. We've expanded that relationship over time across a variety of mandates in the equity spectrum. So think U.S., non-U.S., growth, value, et cetera. And we're really excited to continue to have the opportunity to expand the relationship into the future.
And Kim, from Wellington's perspective, how have you viewed this relationship with Vanguard?
Yeah, sure. So, like Ryan said, that this is a longstanding relationship between our two firms. So we're at the 50-year mark. So we've been at this for decades. I'd say at Wellington, this Vanguard relationship, it's truly a part of our DNA, and it's one of the most important things that we do. For us, everything we do is active management. And so that's really been a part of our foundation going back nearly 100 years.
So Ryan, despite Vanguard's long history in active management, as we're discussing here, these ETFs that launched in November, these were Vanguard's first foray into active equity ETFs. And so I think the natural next question, at least for me, is why now? Why was this the right time to launch active equity ETFs?
It's a fair question, Nate, and we understand the question. As we see it, it's a natural next step from two angles. I think first, it's a natural next step as we look at our active ETF lineup, and that's inclusive of equity and fixed income. I think you've noted before, and you're well aware that we've launched several strategies over the last 12 or so months, predominantly on the fixed income side, some active strategies, some index strategies. And again, when you reflect on what we've offered clients for many decades, we want to be able to deliver our strongest capabilities in the vehicle that they prefer, right? So this is very much in line with that. So that's one angle in terms of it being a natural extension. The other would be the Wellington partnership. We've been able to build a robust partnership with Wellington across the mutual fund landscape for many, many years. And this gives us a chance, again, to look at the capabilities that Wellington has and deliver those capabilities in the vehicle of choice and be really thoughtful about the types of strategies that we're delivering as well, that I'm sure Kim could go into more detail with. But as we looked at these strategies to start off, they made a lot of sense because they can serve as core building blocks for investors, core building blocks being accessed in a low-cost, transparent, and tax-efficient manner.
Sort of on that note, from Vanguard's perspective, how do you think about investor needs and expectations for active products in an ETF wrapper? Because as you know, there's been a lot of product proliferation in this category over the past several years. And so I'm curious, what do you think investors are looking for, and why do you believe Vanguard is well positioned to meet these needs and expectations?
Yeah, well, first I would start with our ETF expertise, right? I think you mentioned the number at the onset, Nate, in terms of the AUM that we manage, and that's 25 years of experience and expertise. We feel like we know the wrapper really well, and we have a strong brand for clients in terms of what it takes to be successful in the vehicle. And then second, I think related to your question in terms of timing, we want to be really deliberate in our product development approach to ensure that the products we're delivering, the strategies we're delivering, regardless of format, regardless of style, regardless of asset class, are enduring and they're meeting client needs. It's a big challenge when you have 50 million investors that you're serving, right? Because there are a variety of needs and preferences at all times of the day. But obviously we wake up every day and we're excited to try to meet that challenge. And so I think that's how we want to approach it. We want to be deliberate from a product development standpoint, continue to offer enduring strategies that meet client needs, and to continue to do it in a low cost and within the right vehicle.
In terms of the 3 ETFs that launched in November, again, there's a U.S. value active ETF, a U.S. growth active ETF, and a dividend growth active ETF. Kim, do you want to discuss Wellington's investment approach here at a high level? And if you'd like to select one of these ETFs as an example, maybe that's a good way to do this, but I'll defer to you on how you want to answer that. But talk about Wellington's investment approach.
Yeah, sure. Thanks, Nate. And I just want to pick up on a couple things Ryan said, which is, the broad approach here is bringing best-in-class equity solutions, right, for our client, our collective clients. And, we think about that through the lens of performance, dependability, and then the trusted value that Ryan talked about, and that long history that Vanguard brings of delivering exchange-traded funds to investors. I'll focus on the performance side of things and the process that we undertake at Wellington. So as active managers, every investor at Wellington needs to have a clearly articulated philosophy and process. So the philosophy is, what market inefficiency do they see? And then the process is, what are the steps they take to exploit that market inefficiency and achieve returns that are above a stated benchmark? And so that's everything from what types of companies we're going to own, how a stock gets into the portfolio, how we're constructing the portfolio, and, when it's time to sell an investment. So, is it valuation? Is it because something changed in the thesis? And so that is a part of our everyday. That's what we do day in and day out. And one of the most important things we always say, okay, you've got your philosophy and your process, but what is your edge? What is it you as an individual investor bring to the table, or as an investment team, that's going to allow you to exploit that market inefficiency? And so maybe, one example, if I take the VUSG, the U.S. growth approach, it's a U.S. innovation based philosophy and process. And so you have two portfolio managers, in Brian Barbetta and Michael Mazdea, who have a long history of managing money on a diversified basis. But they both also have a history in the technology sector. And as we all know, a lot of the innovation that we're seeing in the global economy is coming from technology. And so that really underpins some of their edge in identifying these innovative companies. They also have at their disposal Wellington's many resources that focus on an area like healthcare, where much of the innovation in the market also comes from. And so I'd say it's those two things that allow them to put a portfolio together of innovative companies that will hopefully grow through market cycles and regardless of market cycles, because they're either disrupting an existing market or creating a new market.
And I think we were alluding to this earlier, but with all 3 of these ETFs, I just want to be clear, the underlying investment strategies are similar to those offered in the mutual fund wrapper right now. Is that correct?
That's right. Yep. I would say that if you take VDIG, which is probably our coolest ticker, that's the closest to a mutual fund strategy that is available as standalone. It's very similar to the Vanguard dividend growth strategy. It's a more concentrated version. The U.S. growth one that I just talked about, that's a component part of the Vanguard Global Equity Fund. And the U.S. value approach, which is more of an opportunistic value approach, is very similar to the Vanguard Windsor Fund, managed by Dave Palmer.
Yeah, Nate, that was inherent in our product strategy as well, right? Because we felt fortunate, if you think of what we've built over the last 50 years, to have a roster of proven managers and proven strategies. And so it really allowed us to start fresh in some respects and say, hey, let's look at this roster. Where do we have a high degree of conviction? Where can the strategy play a key role for client portfolios, and how can we offer it in the wrapper of choice for many clients at the right price?
Okay, so that's perfect. In just a few minutes left here, because I'd love to have you tell us whatever you can about the future product roadmap here in terms of actively managed ETFs. And I know you're not going to give us the full playbook, but maybe at a high level, how will Vanguard continue to approach this category?
Well, at the highest level, yeah, we want to continue to evolve with our clients' needs and preferences. So, it's clear that the demand for the ETF wrapper is there. Obviously, we want to be thoughtful as it relates to which strategies we deliver through that wrapper, because maybe it's obvious, but I'll say it anyway. The ETF is not magic in terms of delivering alpha, right? I think Kim made the point earlier that you want to identify managers and strategists with a discernible edge, and ensure that edge is long-term and enduring in nature, and that we can deliver it together at the right price point for the end client, so that they get a chance to enjoy in the outperformance of the strategy. So that overarching philosophy will continue to drive how we think about active management, active equity management, and what's next for Vanguard. We feel fortunate. The history has allowed us to have north of $700 billion in active equity assets spread across 40 funds with 60-ish underlying strategies. And in addition to Wellington, we have a chance to partner with 20 additional sub-advisor firms too, including our own quantitative equity group internally at Vanguard. So it gives us a lot of choice and the opportunity to be thoughtful. But I think what you can expect over time, Nate, is that as clients' needs continue to evolve, we want to meet them. So we'll want to offer clients a comprehensive lineup and give them the choice to be able to build portfolios in a thoughtful way with active equity ETFs, in addition to passive ETFs, active fixed income ETFs, et cetera.
Well, Ryan, Kim, greatly enjoyed having you on here this week. Thought really nice perspective around active ETFs. So thank you for that, and thank you for joining me.
Great. Thanks, Nate.
Thanks, Nate. Really appreciate the time.
That was Ryan Barksdale, head of active equity product at Vanguard, and Kim Galen, head of equity boutiques at Wellington Management. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I will be joined by one of my favorite ETF resources, Matt Bartolini, Global Head of Research Strategist at State Street. So we're going to cover an entire range of ETF topics. Hope you'll join us. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.